In today's interconnected world, businesses constantly seek funding sources to fuel their growth. While traditional avenues like bank loans exist, a powerful alternative has emerged: external commercial borrowings, or ECBs. Simply put, ECBs are loans that companies and institutions secure from foreign lenders. This cross-border borrowing opens up a world of opportunities, granting access to larger sums, often at more competitive interest rates. Think of it as a company looking beyond its own borders for the resources it needs to thrive. ECBs are not just about securing funds, they represent a strategic approach to financial management. For businesses in developing countries, ECBs can be particularly transformative. They inject foreign currency into the local economy, bolstering national reserves and stabilizing exchange rates. Moreover, the involvement of international lenders often brings valuable expertise and best practices, fostering knowledge transfer and improving corporate governance standards. Imagine a promising tech startup in India aiming to expand its operations. Local funding might be limited or expensive. By securing an ECB from a venture capitalist in Silicon Valley, the startup can access the capital it needs to scale its business. The Indian startup benefits from the lower interest rates and the expertise the Silicon Valley investor brings. This is a win-win. The startup grows, and the investor reaps the rewards of investing in a promising venture. In essence, ECBs represent a powerful tool for companies seeking to unlock their full potential. By tapping into the vast resources of the global financial system, businesses can access the capital, expertise, and competitive edge needed to thrive in today's dynamic marketplace. Securing an ECB is not as simple as walking into a bank and asking for a loan. It involves navigating a complex landscape of regulations and procedures, often varying from country to country. In India, for instance, the Reserve Bank of India, or RBI, plays a pivotal role in regulating ECBs. It has established two primary routes for companies seeking external commercial borrowings: the automatic route and the approval route. The automatic route, as its name suggests, offers a more streamlined process. Companies meeting specific criteria set by the RBI can secure ECBs without seeking prior approval from the central bank. These criteria typically involve the loan size, maturity period, and the lender's credentials. This route is designed to facilitate quicker access to funds for projects that align with the country's economic priorities. On the other hand, the approval route requires companies to seek explicit permission from the RBI before raising funds through ECBs. This route often applies to borrowings that fall outside the automatic route's parameters, such as loans with a longer maturity period or those intended for specific purposes like real estate investment. The RBI scrutinizes these applications, assessing their potential impact on the economy, adherence to regulatory norms, and alignment with national priorities. Consider a renewable energy company in India planning to establish a large-scale solar power plant. If the project meets the RBI's criteria for size, maturity, and lender credibility, the company could likely secure funding through the automatic route. However, if the same company wanted to use the ECB for land acquisition, a less preferred activity, it would likely need to navigate the approval route, demonstrating the project's economic viability and alignment with national objectives to the RBI. Understanding the nuances of these routes is crucial for companies considering ECBs. Navigating the regulatory landscape effectively can expedite access to funding and ensure compliance with all applicable rules and regulations. By carefully assessing their requirements and choosing the appropriate route, businesses can leverage ECBs to fuel their growth ambitions while adhering to the highest standards of corporate governance and financial prudence. The rising popularity of ECBs in global finance stems from the myriad advantages they offer to borrowers. One of the most compelling benefits is the potential for lower interest rates compared to domestic borrowing options. International lenders often operate in more liquid markets with lower cost of capital, allowing them to offer more favorable terms to borrowers. This difference in interest rates can translate into substantial savings for companies, especially for large-scale projects with long repayment periods. Beyond lower borrowing costs, ECBs provide access to a much larger pool of capital than what might be available domestically. This is particularly beneficial for companies operating in countries with developing economies, where local financial markets might not possess the depth or sophistication to cater to the funding needs of rapidly growing businesses. By tapping into the global financial system, companies can secure the substantial capital required to execute ambitious expansion plans, invest in research and development, or pursue strategic acquisitions. Imagine a pharmaceutical company in Brazil on the cusp of a breakthrough new drug. Developing and bringing this drug to market requires significant investment, exceeding the capacity of local investors. By securing an ECB from a consortium of international banks, the company can access the necessary funds to complete its research, build manufacturing facilities, and launch the drug globally, potentially revolutionizing healthcare and generating substantial revenue. Moreover, ECBs can act as a catalyst for economic growth and development, particularly in emerging markets. The inflow of foreign currency strengthens national reserves, stabilizes exchange rates, and supports the local currency's purchasing power. This, in turn, can attract further foreign investment, creating a virtuous cycle of economic expansion. Furthermore, the involvement of international lenders often brings valuable expertise, technology transfer, and best practices, fostering innovation, improving corporate governance standards, and enhancing the overall competitiveness of the borrowing company and the local economy. While ECBs offer a compelling avenue for securing finance, they are not without their challenges and considerations. One of the primary concerns for borrowers is the potential foreign exchange risk associated with ECBs. Since loans are typically denominated in a foreign currency, fluctuations in exchange rates can significantly impact the cost of borrowing. A depreciation in the borrower's local currency can increase the debt burden, making repayments more expensive. To mitigate this risk, companies often use hedging instruments, such as forward contracts or currency swaps, to lock in exchange rates and minimize uncertainty. However, these hedging strategies come with their own costs and complexities, requiring careful consideration and expert financial management. Borrowers need to weigh the benefits of lower interest rates against the potential risks associated with currency fluctuations. Consider a Turkish company that secured a large ECB denominated in US dollars when the Turkish lira was relatively strong. If the lira were to depreciate significantly against the dollar, the company's debt burden in local currency terms would increase, potentially straining its finances. To avoid this, the company could have used a currency swap to exchange its lira liability for a dollar liability at a predetermined exchange rate, effectively hedging against adverse currency movements. Furthermore, ECBs come with a web of regulations and restrictions that vary across jurisdictions. Governments often impose limits on the amount of foreign currency debt companies can accumulate, the permitted end use of funds, and the eligible lenders. These regulations aim to prevent excessive reliance on foreign capital, manage systemic risks, and ensure that ECBs align with national economic priorities. Navigating this complex regulatory landscape requires careful planning, legal expertise, and a thorough understanding of the rules governing ECBs in both the borrower's and the lender's jurisdiction. As the world becomes increasingly interconnected, the role of ECBs in global finance is only set to grow. For companies seeking to expand their horizons, access a larger pool of capital, and benefit from competitive interest rates, ECBs will remain an attractive financing option. However, it's crucial to recognize that ECBs are not a one-size-fits-all solution. Borrowers need to carefully weigh the advantages against potential risks, such as foreign exchange volatility and regulatory complexities. The future of ECBs will likely be shaped by technological advancements, evolving regulations, and the global economic landscape. Fintech innovations, such as blockchain-based lending platforms, have the potential to streamline the ECB process, enhance transparency, and reduce transaction costs. These platforms could connect borrowers directly with international investors, bypassing traditional intermediaries and opening up new avenues for cross-border financing. Imagine a scenario where a renewable energy startup in Southeast Asia can secure funding through a global blockchain platform. Investors worldwide can assess the project's viability and contribute funds securely and transparently. Smart contracts could automate loan agreements, reducing the need for intermediaries and expediting the financing process. However, as technology lowers barriers to entry, regulators will likely play a more prominent role in overseeing these cross-border transactions, ensuring financial stability and mitigating risks associated with money laundering and illicit financial flows. The global regulatory landscape will need to adapt to these technological advancements, striking a balance between fostering innovation and maintaining financial integrity. In conclusion, ECBs will continue to be a vital tool for companies seeking to unlock global finance's power. As the world evolves, so too will the mechanisms, regulations, and opportunities associated with ECBs. By understanding the intricacies of this evolving landscape and adopting a strategic, informed approach, businesses can harness the power of ECBs to fuel their